Welcome back. We're hunting for yield with Jenny Harrington. Her top dividend plays for the new year. Okay, you have 4 for our viewers. Let's go through them.
Okay, I tried to do it like a Christmas present, so I'm giving you a wide variety, a REIT, a material, an energy, and a healthcare stock. We've got Amcor, Bristol Myers, Enbridge, and Vici. Most of them have about a 6% yield, other than Bristol Myers, which is about 4.5%. They're all in that kind of 10 times earnings range. They all have decent earnings growth ahead. Bristol's earnings growth is further out, but in the meantime, Bristol is a huge cash cow. And they all have something, I think, out of the 33 or 34 stocks in our portfolio, the reason I chose these is because they should give you a nice, safe way to have dividend income next year, no matter what the market does. So Amcor, for example. Amcor had a huge merger with Berry, their biggest competitor, and as that integration happens, they've got 13% earnings growth ahead next year, 11% after that. It's a dividend aristocrat, completely unappreciated. Bristol, I think with the way we've been seeing the healthcare conversation go and the drug stock pricing, there's finally some appreciation. Those stocks have all been under a cloud, and it looks like at least there's some clarity coming. So Bristol should be a beneficiary there. Enbridge, a huge pipeline company. They've got about 40,000 miles of oil and gas pipeline in Canada and North America. If we think the data center play continues and there's unfettered demand for energy, you want to be in both oil and gas. I don't want to play the cycle on oil and gas prices. I just want to know that if it's moving, I'm collecting income there. And lastly, Vici. Vici's a pretty cool company. So they own mostly casinos. They have some bowling alleys too, but think of it as casinos. And their tenants are companies like MGM and Caesars. So they have 100% occupancy. During the pandemic, when almost every REIT out there had some occupancy issue, they maintained 100% occupancy. That should continue into the future. It's on sale right now. It's down almost 10% from its high a few months ago because people are saying ooh, Vegas isn't doing well, international travel. Wow. That doesn't matter. Caesars isn't saying suddenly we're going to stop leasing major casinos from you.
Yeah.
Those are super long term. It's a triple net lease.
I got a question for you.
Yeah.
I got a question for you.
Bring it.
Where's the disconnect then? I mean, if they're so heavily, levered to casinos, pull up Wynn. Yeah. Year to date.
Oh, but
Las Vegas Sands.
But those are
LVS.
Different businesses. Those are not triple net lease REIT companies.
But I mean, you said as part of your thesis that why the stock hasn't done well. Oh, Vegas.
In the last couple months.
This stock. The stock's up 45% year to date. Casino stocks have done great.
Okay, but I'm just saying you can buy it now. It's 10% off its high.
No, I know, but why is it down?
I think it's silly. I think because there's been conversation about weakness in Vegas. Oh, and then there also maybe a little bit of the stock had run up into that because there was the thought that there was going to be a gaming license in New York City that didn't happen. So it backed off after that. But the bottom line is you get something with a 6.4% yield, 100% occupancy, one of the hands-down best management teams, and this is our job as active investors.
This chart's just strange to me, the comparison. That's why I ask you the question. If there was a negative feeling on Vegas, Wynn and some of these others. Now, I know Macau's part of it, obviously.
Maybe if we're getting that granular, maybe it's more the New York license.
You mentioned that.
Because don't you hear that? Don't you hear people talking about Vegas volumes are down?
No.
I thought it was, you don't? I do. Everywhere I turn, Vegas is down, international travelers are not so great. And maybe this is more in the stock picker side of this. I was even at a conference over the summer where someone, I can't remember where it was from, maybe Bernstein or somewhere, used this stock as their top idea at this conference. And a huge part of that conversation was, hey, there's concern over Vegas, take a step back and understand that these are super long-term 20-plus year leases with high grade tenants. You don't need to worry about that rent roll.
So maybe you just got rid of it in your rebalance.
Yeah, we sold it.
Well, you would have had to. I mean,
we sold it at the end of October.
3 months down 13%, 6 months down 15. I'm not calling out a stock pick.
You're just saying why versus Vegas.
Yeah, it's just peculiar to me that
Vegas
this one, if it's so levered to Vegas and the Vegas stocks have done great, this one's done
it's chatter.
Garbage.
And maybe it's more in New York. I thought it was more Vegas. If you're saying it that way, maybe there's more New York in it, which was the New York gaming license, and maybe it had run up a little bit. But I think every time I tell someone, oh, I bought Vici, here's why. They say, oh, but aren't you worried about Las Vegas? And I say no. So that's why I put that out there first. I wasn't doing it as a comparison.
Well, I understand. What do you think of some of these other picks?
Some of the other picks.
Bristol?
Yeah. Bristol's good. I don't know if Jenny looks at Merck. Merck, to me, looks like It's breaking out currently. I like some
What's
of the other
yield?
picks.
Do you know?
On Merck?
It's like 3.5%.
3.5%? Okay.
Do you pick Bristol over something like that because it has a higher yield?
I bought Bristol. A year and a half ago at $47 when the yield was over 5%. So that's where I put my money. At that point, by the way, Merck was a lot higher. Merck at that point probably had about a 3%
Are they going to do another
yield.
deal like Celgene, which was really not a successful deal?
I mean, here's the thing on Bristol. Their cash flow is bananas.
Yeah.
So I don't know if they'll get it right, but they can certainly buy their way to growth over the next 3 or 4 years, maybe 10 years. The cash is unbelievable.
If we bring things full circle from the top of the show where we were discussing the idea of higher rates for longer, is that an impact then on dividend paying stocks? And if you say, well, we did just shy, the DVY did just shy of 10% this year, here we're having a conversation about the prospect of higher rates. That's bad for dividend paying stocks, isn't it?
You need to take it two ways. So Josh made a very good point earlier, which is let's say the 10-year ultimately plateaus in that 3.5%, 4% range. When I started managing this portfolio back in 2001, the 10-year treasury was 5%. So if you need income and you need that income to keep up with GDP, dividends are still better. So if you're, for the strategy that I manage, for example, my goal is to have a 5% or better dividend yield. That dividend yield historically has grown at about 5.5%. Coincidentally, the S&P's dividend yield also, dividend income also grows at 5.5%. So if you need income and the 3% on treasuries isn't enough and you need that income to grow, then it's still favorable. Where it gets tricky, and this goes back to Torsten saying plan accordingly, is when I'm researching a company like Amcor, one of the hardest things to do now is to look at their debt portfolio and say, they have a lot of maturities in 2027. Where are those going to reprice? And if I don't think rates are going back to 1%, how much is that going to impact their interest expense and earnings? That's where it gets hard.
All right, good stuff.